Brown & Brown started in 1939 by Hyatt Brown in Daytona Beach, Florida, a small regional brokerage that became one of the largest insurance brokers in the United States.
And the first thing to understand about BRO is what kind of insurance company it actually is. Brown & Brown does not underwrite policies. It brokers them. That is a fundamental distinction.
Right. When a hurricane hits Florida, the insurer pays the claims and absorbs the loss. BRO just collected its commission up front and walked away. No catastrophe exposure, no reserve risk.
That business model is why BRO's earnings are smoother and more predictable than underwriters. Commission revenue grows when insurance rates rise and when BRO adds new clients or acquisitions.
The family story is central here. Hyatt Brown founded it. His son J. Hyatt Brown joined in 1959 and built the public company. Then Powell Brown, third generation, took the CEO seat in 2009.
Powell started as a producer in 1995, ran the retail division for 8 years, and then stepped into the top role. 3 generations, all lifers. Family ownership keeps long-term thinking in the DNA.
The M&A engine is the other pillar. Over 200 acquisitions since the 1993 IPO. They buy regional brokers, keep the producers in place, and let the local relationships compound under the BRO platform.
The playbook is disciplined. They target smaller regional specialists where the seller wants a home for their team, not just an exit check. Retaining producers is how BRO prevents revenue from walking out the door after a deal.
Revenue crossed $4.5 billion in FY 2024, up from $2 billion in 2019. That doubling in 5 years is a mix of roughly 10% organic growth and consistent bolt-on M&A, adding another layer each year.
Organic revenue growth came in at 9.8% in 2024, accelerating from 7.2% the prior year. That acceleration matters. It tells you pricing tailwinds from the hard insurance market are still flowing through.
Let us break down the 4 segments. Retail is 50% of revenue. Commercial and personal lines sold through BRO's local offices to businesses and individuals nationwide.
National programs is 24% and the most defensible segment. BRO manages specialty insurance programs for niche industries, think homeowners associations, equine, or trucking, where BRO is the go-to market.
Wholesale brokerage is 16%. BRO acts as a wholesaler connecting retail agents to specialty and excess and surplus lines carriers for harder-to-place risks. Services rounds out the last 10%.
EBITDA margin expanded to 27.3% in 2024, up 80 basis points. As organic growth accelerates, more revenue drops through at high incremental margins because the fixed cost base does not scale proportionally.
On capital allocation, the acquisition spend over the last 5 years totals $3.2 billion. Debt to EBITDA sits at 2.8 times, within their stated target range and manageable given the stability of commission cash flows.
The hardening insurance market has been a genuine tailwind for brokers. When carriers raise rates, broker commissions, calculated as a percentage of premium, rise automatically without BRO taking on any extra risk.
Which brings up the risk to monitor, rate softening. If carriers start cutting premiums to win back market share, broker commissions compress. That is the key cycle risk for BRO's organic growth story.
The dividend is a 30-year consecutive increase streak. The yield is only 0.5% at current prices. BRO prioritizes M&A deployment over dividends. But the streak signals earnings durability across many cycles.
EPS grew 16% in 2024. Commission retention rates run around 90%. Clients renew policies, BRO keeps collecting. That recurring revenue base is what makes the model so predictable year to year.
Versus peers, Arthur J. Gallagher matches BRO on M&A track record and beats it on total revenue growth, but operates at larger scale. Aon and Willis Towers Watson run higher EBITDA margins but far lower M&A velocity.
BRO's edge in the peer comparison is the combination of organic growth, M&A compounding, and family alignment. The Hyatt family's continued majority ownership maintains operational focus that diverges from peers managed primarily for quarterly earnings cycles.
Book value per share grew from $8.50 in 2018 to $22 in 2024, nearly 2.6 times in 6 years. Much of that reflects intangible value from acquired books of business being capitalized on the balance sheet.
The national footprint today, 600-plus offices, all 50 states, over 1 million clients served, roughly 5,000 producers. That scale took 85 years to build and creates density that new entrants cannot replicate quickly.
Bro's return on equity has averaged above 15% across a decade of acquisition cycles. The company generates consistent free cash flow from an asset-light brokerage model, funding M&A without sustained high leverage.
Competition for regional brokers is heating up. Private equity is aggressive in the space. They pay high multiples for the same assets BRO is targeting. That could push acquisition prices higher and compress BRO's deal returns.
The key watch items heading into 2025: whether organic growth stays above 8% as the hard market softens, and whether BRO can continue sourcing quality acquisitions at reasonable multiples despite PE competition.
That's the Brown & Brown story. 85 years of brokerage compounding, 3 generations of family discipline, and 200 acquisitions executed with the same playbook.
On the bridge, we look at organic growth, sustainability, and whether the M&A engine can keep running as competition for regional brokers heats up.
Welcome back to Charged Alpha. I'm Hudson, and joining me as always is Lana. Today we are breaking down Brown & Brown's first quarter 2026 earnings, a pure-play insurance brokerage that just printed its 19th consecutive quarter of organic revenue growth above 7%, beat on EPS by nearly 10%, and raised full-year guidance. Let's get into it.
Brown & Brown traces its roots to a small, independent insurance agency in Daytona Beach, Florida, an operation that has since grown into one of the largest specialty insurance brokerage platforms in the United States. What distinguishes this company structurally is that it never underwrites a single policy. It is a pure distribution business, placing risk on behalf of clients and collecting commissions, which means it carries no catastrophe exposure on its own balance sheet.
Let's get straight to the Q1 numbers. Total revenue came in at $1.283 billion, beating the street estimate of $1.235 billion by 3.9% and growing 8.6% year over year. This was not a narrow beat. It was broad-based across all 4 business segments, which tells you the demand environment for insurance brokerage services remained strong through the quarter.
Adjusted earnings per share hit $1.04 versus the consensus estimate of 95 cents, a 9.5% beat. EPS also grew 9.5% year over year. The market responded exactly as you would expect. The stock jumped 4.8% on earnings day, closing at $96.50. That reaction is consistent with a company that continues to clear a high bar quarter after quarter without surprising to the downside.
The metric that every insurance brokerage analyst tracks more closely than anything else is organic revenue growth. The revenue increase attributable to existing operations, stripping out acquisitions and currency effects. For Q1 2026, Brown & Brown printed 7.8% organic growth. In a quarter where commercial property rates were actually softening 3 to 5%, that number is genuinely impressive and speaks to the quality of their producer base.
7.8% organic growth means the business is winning new clients and expanding wallet share with existing clients faster than any rate headwind can offset. New business generation, coverage additions, policy count expansion, all of those levers are firing simultaneously. That is the definition of a well-run distribution business operating at full capacity.
Breaking down organic growth by segment, National Programs led the way at 9.2%. National Programs is their specialty insurance segment, purpose-built programs for niche industries like dental professionals, community associations, habitational properties, and social service agencies. These programs are hard to replicate, carry high margins, and are largely insulated from the commodity pricing pressure that affects standard commercial lines.
Retail, their largest segment at roughly half of total revenue, delivered 8.1% organic growth. Retail is the traditional core of the Brown & Brown model. Local market commercial and personal lines brokers serving small and mid-market businesses across all 50 states. When retail grows at 8% organically in a soft property market, it means their producers are outworking the competition for new business day after day.
Wholesale brokerage came in at 6.8% organic growth, slightly below the other segments, but still a strong result. The wholesale channel handles surplus lines and hard-to-place specialty risks, where pricing has been the most competitive in recent quarters as capacity has returned to the market. Growing above 6% in that environment validates the depth of their carrier relationships and their ability to find coverage solutions that competitors cannot.
Services, the fourth segment, is their managed care, social services, and claims management business. It generates fee-based revenue rather than commissions, making it structurally different from the other three segments. Fee income is more stable through market cycles because it is tied to service contracts rather than insurance premium volume. Services grew at mid-single digits in Q1, consistent, recurring, and a good ballast to the commission-driven segments.
Here is the broader rate environment context. Commercial property rates have been softening 3 to 5% in recent quarters following the reinsurance market's recovery from the 2023 catastrophe season. When property rates decline, the commission on the same policy is smaller. Brown & Brown grew through that headwind by expanding volumes and winning new accounts, which is a meaningful demonstration of competitive strength.
Casualty lines, general liability, workers' compensation, commercial auto, remain flat to slightly positive on pricing. Professional lines like directors and officers coverage and errors and omissions are increasingly competitive as cyber awareness has brought more carriers to market. But embedded within that complexity is an opportunity. Clients need expert guidance now more than ever, and Brown & Brown's consultative model is built exactly for this environment.
Their commission revenue is not simply a function of premium rate changes. It also grows through new client wins, coverage expansions on existing accounts, additional policy lines, and the penetration of new specialty products into existing client relationships. Cyber liability is the best example, growing more than 30% annually inside national programs because every business with a digital footprint now needs it.
Now let's talk about margin expansion, which was the second major highlight of this quarter. Adjusted EBITDA margin came in at 28.8%, 150 basis points above the prior year quarter of 27.3%. That expansion is happening not through aggressive cost-cutting, but through pure operating leverage. Revenues growing faster than the cost base, year after year, quarter after quarter.
Two forces are driving the margin expansion simultaneously. First, organic revenue is growing at 8%, while headcount growth runs at a low to mid-single-digit pace. That spread, revenue growth outpacing people costs, is the mathematical engine of margin expansion in a services business. Second, integration savings from the 2025 acquisition cohort are now flowing through as those acquired offices reach their full productivity potential.
The long-term EBITDA margin target communicated by management is 30%. They are at 28.8 today. The path from 28.8 to 30 is not a restructuring story. It is a straight line of operating leverage driven by organic growth outpacing compensation inflation. At the current trajectory, 30% EBITDA is achievable within the next 6 to 8 quarters.
Cash flow was excellent. Operating cash flow for Q1 hit $285 million, representing a high conversion rate from EBITDA to free cash. This is the lifeblood of the entire business model. Strong free cash generation is what simultaneously funds the dividend program, the acquisition pipeline, and the share repurchase authorization, without the company ever having to lever up dangerously.
On acquisitions, Brown & Brown closed 3 deals in Q1 2026 with a combined $85 million in annualized revenue. These were smaller regional books of business, their classic bolt-on acquisition profile, purchased at 8 to 10 times EBITDA, integrated quickly using their standardized playbook, and expected to contribute 12 to 15 cents of incremental full-year EPS once fully embedded in the cost structure.
The M&A pipeline as of the Q1 call remains robust, with management citing more than 15 transactions in various stages of evaluation. Brown & Brown has one of the most sophisticated small book acquisition programs in the industry. They have done this process hundreds of times. And the repeatability of the integration model is itself a competitive moat that is nearly impossible for a startup or regional player to replicate.
What makes their acquisition model genuinely differentiated is price discipline. They walk away from transactions where sellers have unrealistic valuation expectations. That willingness to be patient, to let deals that do not meet their return hurdles go to competitors, is what preserves the long-term returns on acquired capital and explains why the returns on their M&A program have been so consistently strong over decades.
Capital return highlights for the quarter. The board declared the 31st consecutive annual dividend increase, raising the quarterly dividend from 14.5 cents per share to 15.5 cents, an annualized rate of 62 cents per share, yielding approximately 64 basis points at the current stock price. 31 consecutive years of dividend increases is a remarkable demonstration of compounding consistency.
The dividend yield at 64 basis points is intentionally modest. Powell Brown has been consistent over the years in explaining that retained capital deployed into acquisitions at 8 to 10 times EBITDA generates higher long-term returns for shareholders than distributing that cash as dividends. The buyback program supplemented that. Brown & Brown repurchased $120 million of stock in Q1 alone.
Moving to guidance and the forward EPS projection, management maintained their full-year 2026 adjusted EPS guidance range of $3.75 to $3.90. At the midpoint of $3.82 and a current stock price of $96.50, that implies a forward PE ratio of 25.5 times, a meaningful discount to Brown & Brown's own decade-long average of 30 times forward earnings.
Equally notable, they raised their organic growth guidance range for the full year from 6 to 8% up to 7 to 9%. Revenue guidance came in at $5.1 to $5.3 billion for full year 2026. Management raising organic guidance after Q1 is a strong signal. It means they entered the renewal season with confidence in both client retention and new business momentum.
The 4 to 5 turn discount to historical PE average is the central valuation argument here. The market is applying a modest haircut, likely reflecting concerns about whether organic growth can sustain above 7% if property rate softening accelerates. Q1 organic at 7.8% just answered that concern with the most direct evidence possible: demonstrated results.
Powell Brown's earnings call commentary was characteristically straightforward. He emphasized that the macro backdrop for insurance spend remains constructive. Business formation, property values, workforce costs, and healthcare inflation all drive premium volumes regardless of where property rates move in any given quarter. Volume, not just rate, is the engine of commission revenue.
He highlighted client retention as the bedrock of the entire model. Renewal retention rates held at approximately 92% in Q1, meaning for every $100 of expiring premium volume, $92 automatically renew before a single new sale is needed. That structural starting point is what makes the organic growth layered on top so powerful. You are growing from a nearly fully retained base.
92% retention is not an accident. It reflects years of relationship investment, deep account knowledge, and the operational cost of switching that makes clients reluctant to move their insurance program. When a Brown & Brown producer has managed a client's insurance program for 5 or 10 years, that client would need to be extraordinarily unhappy to justify the disruption of moving to a competitor. And Brown & Brown works hard to prevent that unhappiness.
The balance sheet position is healthy and improving. Net debt finished the quarter at $3.7 billion, representing 2.5 times trailing EBITDA, down from 2.8 times a year earlier. They carry a $2 billion revolving credit facility that provides significant acquisition firepower on short notice, maintaining the optionality to pursue larger transformational deals if the right opportunity appears.
Brown & Brown holds an investment-grade credit rating from Moody's at Bay2. That matters operationally because it allows them to access acquisition financing at competitive borrowing rates, preserving the economics on every deal they close. A company that finances bolt-on acquisitions at 5% debt cost and earns 12 to 15% returns on those acquisitions, is creating meaningful economic value with every transaction.
Let's spotlight one segment-level trend that deserves more attention: cyber liability inside national programs. This is one of the fastest-growing specialty lines in all of commercial insurance. Every business with a meaningful digital footprint is an addressable client. Awareness of cyber exposure is rising sharply after high-profile breach events, and regulatory requirements are pushing more companies to formalize their cyber risk programs.
Brown & Brown's national programs team built out a cyber specialty practice years before this became the must-have product category it is today. That early investment means they have deep carrier relationships, proprietary program structures, and experienced underwriting expertise that smaller regional brokers are years away from replicating. First-mover advantage in a fast-growing specialty line is a compounding asset.
The employee benefits consulting piece of the retail segment is another underappreciated growth driver. With healthcare cost inflation running above 6% annually, mid-market employers are actively seeking expert brokers who can optimize plan design, improve carrier negotiations, and reduce total cost of benefits. That consulting value proposition is exactly what differentiates a high-quality retail broker from a commodity placement shop.
Employee benefits consulting is also strategically valuable because it is less correlated with the property and casualty pricing cycle. As that practice grows as a percentage of retail segment revenue over time, the consolidated earnings profile becomes more resilient through soft P&C markets, a natural diversification that management has been deliberately cultivating.
Now let's set the valuation in proper context. Enterprise value of $36.6 billion divided by forward EBITDA of approximately $1.65 billion gives an EV to EBITDA multiple of roughly 22 times. At the same time, the forward PE of 25.5 compares favorably to the company's own historical trading range of 26 to 32 times over the prior cycle peak.
Here is what that valuation picture means in practice. Brown & Brown is growing organic revenue faster than any of its major publicly traded peers, expanding EBITDA margins toward 30%, generating strong free cash flow, and compounding book value per share at 15% annually. Paying 25.5 times earnings for that growth profile is a below-average price for an above-average business.
The historical compounding record is worth stating explicitly. Over the past decade, Brown & Brown has delivered an average annual total return of approximately 15%. That return comes not from multiple expansion or financial engineering. It comes from 14 consecutive years of EPS growth, disciplined M&A accretion, and a dividend program that has grown for 31 consecutive years. This is one of the cleanest compounding stories in the financial sector.
When we compare against rivals including Arthur J. Gallagher, Aon, and Willis Towers Watson, Brown & Brown's 25.5 times forward PE stands out as a clear discount. AJG trades at 30 times forward earnings, Aon at 24 times, WTW at 20 times. Yet Brown & Brown's organic revenue growth rate, 7.8% in Q1, exceeds all three of those peers in their most recent comparable periods.
AJG is the closest peer on growth profile, but Gallagher has scaled through transformational acquisitions at higher multiples that compress near-term returns on capital deployed. Brown & Brown's disciplined bolt-on model, consistently paying 8 to 10 times EBITDA, has historically generated superior incremental returns on acquisition capital compared to AJG's larger, more expensive deals.
Aon and Willis Towers Watson are structurally different businesses. They are global risk advisory and reinsurance intermediary firms with much greater exposure to capital markets conditions, international macro, and the reinsurance pricing cycle. Brown & Brown's U.S. middle market focus insulates it from that volatility and produces more predictable, less cyclical earnings.
Let me walk through the bull case scenario. If Brown & Brown sustains organic growth above 7% through the balance of 2026, Street EPS estimates will move above the current high end of guidance to $3.90 or higher. Apply the historical 30 times forward PE multiple, and you arrive at a price target in the range of $117, 21% upside from $96.50.
The Q1 acquisitions provide incremental upside to the street model. $85 million in combined annualized revenue from 3 bolt-on deals closed in the quarter will contribute a full quarter of earnings in Q2, adding an estimated 12 to 15 cents to full-year EPS that the consensus may not yet fully reflect. That is a meaningful tailwind to near-term numbers that makes the current guidance look conservative.
The second bull catalyst is the casualty rate cycle. Loss trends in general liability, commercial auto, and excess liability are beginning to emerge as claim severities rise with inflation. When carriers respond to deteriorating loss ratios by hardening casualty rates in the second half of 2026, that becomes a direct tailwind to Brown & Brown's commission revenue on top of their existing organic growth trajectory.
A third bull catalyst, specialty program expansion at scale. Cyber, habitational, and healthcare-adjacent specialty lines are all growing above 30% annually inside national programs. As individual programs exceed $500 million in annual revenue, the incremental margin accretion from the fixed cost leverage within each program structure becomes meaningful at the consolidated level.
Now for the bear case. The primary risk is commercial property rate softening accelerating beyond the 3 to 5% currently embedded in models. If property rates decline 5 to 8% through the balance of 2026, organic growth in retail and wholesale could compress to 5 or 6%, below the threshold at which the premium multiple of 25 plus times earnings is fully justified.
The second bear case risk, M&A multiples rising in the broker market. Competition for quality regional books of business has already pushed some sellers above 12 times EBITDA. If that environment persists or worsens, Brown & Brown faces a choice between overpaying to maintain deal volume or slowing the acquisition pace and accepting lower EPS accretion from the M&A engine. Either path creates earnings headwind relative to current expectations.
The third risk is macro-driven. A recessionary environment that reduces small business formation, payroll growth, and commercial property values would shrink the premium base on which Brown & Brown earns commissions. The company has navigated every prior U.S. recession effectively, but a deep and prolonged contraction would slow organic growth more than rate softening alone and create a more challenging environment for new business generation.
Balancing the bulls and bears, the risk-reward profile skews favorably at 25.5 times earnings. The bear cases require either a material macro deterioration or a structural change in the property rate cycle worse than what is currently expected. Management has a 30-year track record of navigating both environments while continuing to grow EPS and dividends. That track record deserves a premium in the valuation.
Pulling it together for Q1 2026. Brown & Brown delivered a clean beat on both revenue and EPS, expanded EBITDA margins by 150 basis points, raised full-year organic growth guidance, closed 3 acquisitions, declared a 31st consecutive dividend increase, and bought back $120 million of stock. Every line of the scorecard was green.
The key forward watch item is Q2 organic growth. If the spring commercial renewal season delivers organic above 7%, it confirms that Q1 was not a seasonal anomaly and the guidance raise was conservative. If Q2 organic slips below 7%, say 6 to 6.5%, expect some multiple compression back toward 22 to 23 times forward earnings as the market reassesses the rate environment risk.
The secondary watch for the next 2 quarters is acquisition pace. Brown & Brown typically closes between 8 and 12 deals annually at recent volume. If the pipeline converts 3 or more deals in Q2 at 8 to 10 times EBITDA, that signals the M&A engine is fully functional and the full-year EPS glide path is on track or above the consensus estimate.
For investors building a portfolio of compounding equities, Brown & Brown presents a straightforward proposition: 10 to 15% annual EPS growth, 31 consecutive years of dividend increases, a proven M&A playbook that adds incremental compounding on top of organic growth, and a current valuation that is 4 to 5 turns below the historical average. That combination is rare in public markets.
If you found this analysis valuable, please subscribe wherever you listen to podcasts. Podbean, Spotify, Apple Podcasts, or wherever you catch us. Leave us a review if you have a moment. Every rating helps other investors discover Charged Alpha, and it genuinely supports the work we put into producing these episodes week after week.
Our full video version with slides, charts, and the complete financial walkthrough is published to YouTube with every episode. Search Charged Alpha on YouTube or follow the link in the show notes. We recommend watching the video version for the charts segment. Seeing the income waterfall and peer comparison visually adds context that audio alone cannot deliver.
Coming up next in our earnings rotation, NOV Inc. and Cincinnati Financial are both in the queue, two very different businesses with very different Q1 setups. NOV is an oilfield equipment and services play, and Cincinnati Financial is a property casualty insurer with a legendary dividend record. Stay with us for both.
Thank you for making Charged Alpha part of your investment research process. Our goal has always been to deliver the same quality of earnings analysis that institutional investors pay substantial subscription fees to access, but present it in a format that works for your schedule, whether that is your morning commute, your workout, or your evening wind down.
This episode is for informational and entertainment purposes only and does not constitute investment advice. Charged Alpha and its hosts are not registered investment advisors. Always conduct your own thorough research and consult a qualified financial professional before making any investment decisions. Past performance of any company discussed is not indicative of future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.